And now the already popular Qasif Shahid Sahab from Finja. Qasif Shahid, again, please. Sorry to have you walk twice. The next in line for us to speak and share a few words is Qasif Shahid Sahab from Finja. I'd appreciate if you can kindly come on stage and take your slot now.
Assalamu alaikum, everyone. Okay, the first thing that I want to talk about is that whenever you look at the world, you look at a region, or you look at a country, always take the long view. Never take the short or the ultra short view. Because if you look around, today, you'll find all doom and gloom. You'll find high-pitched politics laced with sensationalism and bad news, because that's what sells. Long-term good news is not news at all. And that's why most people missed the latest PwC survey that was just presented in the World Economic Forum. And that actually rates the top 32 economies of the world. And guess what? In 2030, which is 8 years from now, Pakistan is at number 20, right behind Egypt and Canada, and ahead of South Africa, Netherlands, Philippines, Thailand, Malaysia, Bangladesh, and so many other countries. And why? Because the next 25 years actually belong to the emerging markets. And in the next few years, China is going to be 1, India is going to be 2, Indonesia is going to be 4, and the UK and the US is all going to continuously lose ground. Eventually, the G7 will be replaced by 6 countries from the emerging markets. Now, Pakistan is very special in this mix. And I'll just give you one fact about Pakistan. There are so many. And, the one that I want to talk about is the demographic dividend that Pakistan has. So Pakistan has 130 million people that are under the age of 30. The average age that we have in this country is 22.8 years. Our Gen Z is more than US or Indonesia. What does that mean? That means that this demographic dividend is going to continue to give advantages to us for the next 20 years till 2040. What this means is that for every one person going out of the workforce, 3 people will come in. It also means that we are going to sort of uplift ourselves in technology adoption. Our productivity is going to go up, and also our consumption is going to go up. And this is opposite to so many other countries, which are aging so quickly. So always look at a region or a country through a long lens. That's the point 1 that I wanted to make. Point 2 that I want to make is that, whenever there is a burning platform, and burning platforms are always followed by what's called strategic inflection points, and I'll explain these. And these are precursors for massive change. So a burning platform is a situation where if you stay the same, you get toasted and roasted and you die, or you vanish, or you become a very small part of your original self. So it's like change through a process of pain. And, so now when you're going to burn, if you stay where you are, change starts to sort of feel more attractive. And, change here is irreversible, and it's dangerous, and it's risky. But, there are some odds that you would survive and thrive and reform as a consequence of that change. And everything in life for humans and for businesses is relative. And whenever there is a burning platform, there is a greater impetus to change. Now, burning platforms are followed by strategic inflection points. Strategic inflection points is a term coined by Andy Grove, who's the Intel CEO in the 90s. And what happens is that businesses have to change their business models overnight when strategic inflection points happen. Let's look at COVID. So COVID is a great burning platform. It's like the ultimate black swan. So in the US, 2004, onwards, every year, online commerce grew at 1% year on year. And by 2020, the online commerce in the US was at 16% of overall shopping or sales. But within a few weeks in that year, it moved 10 points, and it moved to 26% from 16. Now it's in the mid 30s. It's never coming back. So within a few weeks, decades happened. Within a few weeks, e-commerce went from 16 to 26. In Pakistan, there was 95% growth in online commerce. 35% of these people during the COVID time were brand new to online commerce. And it's estimated that by 2023, 23% of commerce in Pakistan is going to be online. And by 2025, will be 26%. And the average order size is going to be about $150, I think close to 30,000 rupees. Also, broadband grew substantially. We've got 54% broadband penetration now. Mobile internet went up. IBFTs grew several 100% in these times. So what I'm saying is that these burning platforms and strategic inflection points do one more thing. They redefine the value that whatever was previously considered value changes when in face of these large changes that happen. For example, earlier, if you were making great pizzas, that's not real value anymore. Now you need to get those pizzas to somebody's house while they're hot and steaming. If you're doing cashing a check at a branch in a good experience, that's not value anymore. Now, as that value changes, it creates an opportunity, a space for new players to come in. And when these new players come in, they apply first principle thinking, and they look at everything in the value chain, and they want to redesign that value chain by putting the customer in the center and by building around that new value. And this is where the incumbents have problems. So if the incumbents don't anticipate strategic inflection points, then they would not get time to reinvent themselves. But if they reinvent themselves and they anticipate strategic inflection points, they become bigger than before. But if they don't, then the castles crumble, and that's when change happens. Now, COVID is one such burning platform, but COVID is followed by many other burning platforms today. For example, the fossil fuel prices going up is a burning platform. Electricity prices, inflation in Pakistan is a burning platform. Money drying up for startups, without having good unit economics is a burning platform. All of these burning platforms are going to be followed by strategic inflection points. So the second point is that we are sitting at a crossroad of a massive change that's going to happen through a multitude of these burning platforms. The third and the final point that I want to make is this, that the opportunity for the banks is not to wake up and get their thing in order, but it's the opportunities for the banks to seize the moment and become much bigger than themselves. That's really the opportunity. And the fact is that today half the world is unbanked, and 90% of the SMEs around the world and in Pakistan, of course, are underbanked and unbanked. So 3/4 of the banking pie is actually vacant. And for banks to take advantage of this is that they have to morph into platforms, and they have to collaborate with fintechs. And when they do that, they're going to win big. Let me explain this. In the 2000s, and this is a very interesting perspective, in the 2000s, everybody thought that technology is actually an isolated, standalone vertical. And it's a domain of Google and Microsoft and Intel. And these are the tech companies. But very quickly, everything changed. And technology, from being an isolated vertical, changed into a horizontal. And what that means is that every industry, every enterprise, every company now is a tech company, because technology runs through a horizontal through all of these verticals. And this is when Mark Anderson came up with this phrase that software is eating the world. Now, whatever happened to technology is exactly the same dynamic that is starting to unfold in banking. So banking is the last isolated vertical, which is heavily guarded, regulated, and all of that. But now banking is about to permeate into the fractured silos of our economy. And banking is going to not be a vertical, but is changing into a horizontal. And how it's changing into a horizontal is because banking is now becoming invisible. It's becoming invisible because banking is going to be, the phrases that people are using now is embedded finance and contextual banking. These things are powered by concepts like banking as a service, banking as a platform, and open banking. And when you play like this, the opportunity is immense. For example, I mean, just imagine the assets that the SMEs and various other non-banking players are sitting on. They have customers, they have relationships, they have customer data, they have insights. And as they open themselves up, and as banking gets embedded in these portals and in these apps, users will be able to go out and avail credit without impacting their customer journeys with zero friction at the real time. That is really the new paradigm of banking. And when you examine closely, you would understand that fintechs and banks are actually sitting on the same side of the table. Banks have very different assets. For example, they have customers, they have distribution networks, they have trust, they have capital, they have licenses. Fintechs on the other side, bring about innovation. They could do product development, they could move very quickly, they can curate phenomenal experiences, but in limited targeted segments. And when you marry the two, the sum is greater than the whole. So what I'm saying is that there are two types of main fintechs. One type of fintechs are the fintechs that are going to help the banks grow from the inside out. And these are the fintechs that will become conduits between the old economy and the new world, and will be the bridges which would take banks to new segments. There are so many examples there. And the other type of fintechs are going to be fintechs that are going to be focused inward to the banks, and they're going to change the banks from the inside, focusing on creating new products and services for these banks and for the customer bases that they have. So in the end, what I'm saying is that banking has an opportunity now to actually eat the world. But for them, for finance and for our industry to change the world, collaboration would have to be key. And if the banks collaborate with the fintechs and morph into platforms, then it's the banks that are going to change the world, just like technology did for the last 20 years. Thank you.
Qasif, Shahid has talked about it's a need to basically convert cash into credit, and I think you've been talking about it for quite a while now, with Finca times and now with a lot of things happening. So my big question to you is, you have quite different ideas about revenue creation for these digital service providers or digital financial service providers. In the context of digital banks that are upcoming in Pakistan, I'm not talking about specifically, I'm just talking about generic. What do you think are going to be the top revenue streams for these digital banks, knowing that the RAS is free and a lot of things actually going to become zero fee element, and you've been a big proponent of don't charge the customer. So how do you see the digital banks going to become profitable? Because if I take a look at it, I think hardly of 200 or whatever banks, 3 or 4 are profitable today. And interestingly, all of them happen to be subsidiaries of the traditional bank, by the way. So how do you see these banks in Pakistan largely going to be profitable, and what are those revenue streams they're going to tap into?
Okay, thank you for asking this question. I want to say a few things. The first thing is that, why the existing banks want to become digital banks is that, when the digital banks come, their cost of funds are going to be much lower than the traditional banks. And today, traditional banks have a competitive advantage, and the competitive advantage is the cost of funds that they have. But once you create greenfield digital banks, they go out and acquire customers digitally. They go out and service those customers digitally. Their infrastructure is in the cloud. They don't have high management costs. They don't have branch networks, etc. So naturally, their cost of funds are going to be lower than the traditional banks, which are bloated in costs. They live in the old world. So that's one reason why existing banks want to be digital banks, because their competitive advantage in cost of funds would cease to exist. Now, when you go out and acquire customers digitally, you can go out and lend to those customers digitally as well. And when you go out and lend digitally, again, you are acquiring those customers digitally. You're scoring them through machine learning, AI. You're dispersing capital credit digitally. You're collecting it back digitally. So imagine a scenario where a greenfield digital bank comes up, it's mobilizing capital digitally, and then it's lending digitally. That's game over. That's checkmate. That's the classic chess move. So now the problem is that it's very difficult. So the revenues are coming from obviously low cost capital, and then the deployment of that capital into new types of lending, which is completely digital. But why is it so hard for existing banks to do all of this? And the reason is that the existing banks, their foundational design is based on branch banking. And it's on top of the branch that we have vertical silos. So all the channels are these vertical silos that are on top of the bank. Now the product heads or the business verticals are also isolated. So it's like the credit card head has its own marketing, own product, own technology, own customer experiences, and all of those things. Then the liability mobilizer has a similar vertical, and nobody really knows what the whole picture of the customer is. It's like, imagine if you go to Amazon and you buy a toothbrush, and now when you're buying toothpaste, the guy who's selling the toothpaste doesn't know that you bought toothbrush. That's really how the banks operate today. So, so it is almost impossible to go out and create this kind of digital bank on an existing bank, because what happens is that we create a spaghetti ware of wiring around the branch model, and over time it becomes super complicated. So the opportunity really here and I agree, I think quite frankly that the existing banks, when they go out and operate digital banks with proper collaboration, have the greatest chance to change the country and the world, rather than standalone fintechs, for example.
Can't wait for too long, Qasif, before indulging you into the conversation. So I think I must say, if anyone who actually started the trend of digital lending, it was yourself through your days of Finja. And I think we remember the days of the payroll advances, and then moving on to Finja lending services with MSME financing, and then more recently, obviously, through your sponsorship of Smart Lane, which is embedded financing on e-commerce. So just talk us through and your experiences of various different phases of digital lending, and what have you learned, and what can you share with us, things to watch out for?
Thank you, Yaya, for the opportunity, for the kind words. At Finja, we have a few theses now. And one of the theses that we hold very dearly is that, cash is fungible. And when you go out and lend cash, then, people can go out and use it whichever way they like. And, Finja largely today is a productive lending player, where we lend, we create credit lines for Kiryana stores and distributors and everybody else in the supply chain. But the way we do it is that when we create those credit lines, the businesses can only use these credit lines to buy supplies. And once they sell the supplies, then they repay us. And what we've realized is that it's not just the FMCG supply chain, but essentially there are hundreds of supply chains in the country. Agri is a big supply chain. A farmer needs input, and they need, and then they create output. So you can create a lending program where you create credit lines for the farmer, And what they're doing is they're buying inputs from those credit lines. And when they're selling the output to a mill or a factory or a market, that market can actually pay you back. And this is how it goes on. So what we've realized is that digital lending has to be done without human intervention. AI and machine learning has to take over. Your ability to acquire users have to be digital. The users would have to pay you back digitally, and you would have to score them digitally. And you would never give cash out, because when you give cash out, it's fungible. Those are really the lessons.
So just a quick fire question, one or two of you can volunteer and respond to that, because at least most of you here in the hall physically, all of you are NBFCs. What about access to continued capital from your partners, their appetite for absorbing losses? What is your strategy for raising capital to lend?
You know, the really cool thing that's going on is what's called off-balance sheet lending. And off-balance sheet lending is a classic example of banking as a service. And how it operates is that the fintech would go out and curate the loans. They will onboard the users. They will score them. But the capital is actually coming from your partner bank. And the revenue is then shared between the bank and the fintech. So the fintech is doing all the work, and the bank is then providing the capital. And this configuration is called off-balance sheet lending, and this is a classic banking as a service play. And you know, I strongly believe that one of the hardest problems in this country to solve is to lend to SMEs and MSMEs, and obviously smartphones as well. And I think that there will be a multitude of fintechs and even startups now morphing into fintechs, because they're all stressed because of negative unit economics. So I see a lot of existing startups morphing into fintechs. A lot of fintechs are there already. So the banks are going to come in and start to collaborate with these fintechs and provide capital, where the fintechs would do the front end work through embedded finance, and the banks will come in and provide the capital. To me, that seems like a classic banking as a service play, which I think is going to transform our country.